The next type of chart pattern that we'll discuss is the continuation pattern. Continuation patterns indicate that the price action of the asset will or is expected to continue its direction after the pattern has been fulfilled. If the price is rising, then the price is likely to continue after the pattern is established. And if prices are falling, price is likely to continue downward after the pattern is established. Let's jump into a few different continuation patterns. The first one we'll discuss is the bullish rectangle. In this particular situation, price has fallen into what can be considered as a period of consolidation, where price is falling into a range of identifiable highs observed in high 1 and high 3, and identifiable lows observed in price 2 and price 4, which we can chart out on a charting platform such as TradingView. We can draw out a rectangle. Price is in this triangle, and it's bouncing back and forth. At some point in our bullish rectangle, which we consider a bullish continuation pattern, we are expecting price to break out beyond this top level, this top resistance level that is forming the top of the rectangle, and to continue upwards to the upside. The main idea, once again, price was trending upwards. It was coming from a lower market area. We were in a upwards market structure, and we have entered a consolidation period. Prices has stayed in a certain range and is consolidating. Markets do not rise or fall forever, and periods of consolidation or sideways movement are common, and it is something that is just a part of the ebb and flow of trading markets. Now, to trade a bullish rectangle, it's typically best to wait for price to break out of the rectangle formed to the upside, then retrace to the support level found at the upper part of the rectangle. If price does not breach the line and continues up, then the pattern is considered valid. It's important to note that sometimes price will break out to the upside and not return to the rectangle line to retest that level of support. If a trade is taken, a stop loss can be placed at the price level formed at the lows 2 and 4 in the rectangle, as if price falls below that level, then the uptrend is considered invalid. Here's the example. Once again, we're looking for this breakout beyond this level formed at the highs of high 1 and high 3. We're looking for a breakout, a higher high formed, and some sort of retracement back to this level that was previously acting as resistance here and here. Now we're looking for it to act as support. We can enter a long trade with a stop loss placed here, slightly below lows 2 and 4. That way, if price were to retrace, maybe it forms a low here, the trade idea is still considered valid because we're still in an overall uptrend. We have not breached the lows here, and we have not produced a lower low, which would be a cause of concern for the general market structure. Once again, though, as with any of these chart patterns, price does not always retrace back to the breakout level, as we see here, and really with any of the other chart patterns. So, the safer way is to wait for a retracement and a retest of the breakout level, the breakout line, and then enter a trade based off of that. But sometimes the price will not stop. Sometimes price will just keep going, and that's okay too. The other example of rectangles in continuation patterns is the bearish rectangle. This is considered a bearish continuation pattern. Once again, price has fallen within a period of consolidation. In this particular case, we were coming from a higher market level and we are seeing a declining market structure, a bearish market structure. Prices are coming down. We've fallen into this period of consolidation with a fixed top and a fixed bottom, as observed in the highs of 2 and 3 and the lows of 1 and 4. What we're looking for in this situation is for price to fall from this high point and to breach past this support level formed at 1 and 4 and to produce a lower low and lower prices. Now, in this situation, it's considered a bearish continuation pattern, implying that falling prices have stabilized into a consolidation zone resembling a rectangle. The highs 2 and 4 and the lows 1 and 3 form the lines of the triangle, of the rectangle, I should say. Now, trading off of a bearish rectangle pattern is similar to the bullish rectangle, but the only thing that changes is the side or direction you are looking to place a trade towards. In this situation, we want to wait for price to break down past the lower line connecting lows 1 and 3 and for price to retrace back towards that line. If price is rejected at that resistance level, then the pattern is considered valid. A short trade can be opened at line 1 and 3 to the downside with a stop placed at the line formed at highs 2 and 4, where if the price were to exceed those highs, then the downtrend can be considered invalid. So here is our example. Price comes down to here. We see price come up to here as well. It falls back down. We see a high price. In this situation, what we're looking for is price to break down beyond these lows and to retrace back up. We can enter a short position at the breakout level, and that should act as resistance. With the short position, we are looking to capitalize if the idea holds and if prices were to continue to fall down. We can set a stop loss at just above the highs observed in the rectangle, because if price were to produce a higher high than the ones observed here at 0.2 and 0.3, then that's an indication that the trade idea is invalid and that we're seeing some sort of reversal to the upside, because now we're starting to see higher highs. The next pattern we'll take a look at are flags. A flag pattern is an area of consolidation that moves against the direction of the general price action movement of the market at that particular time. This pattern is usually made up of anywhere from 5 to 20 candles. There is no hard limit, but these are just some examples, what you might want to look for. Now, flags typically happen after a sharp price increase or decrease. It can look like a flag on a flagpole, where the pole is the initial price movement and the flag is the section of consolidation. The bottom part of the flag should not go past the middle of the flagpole before it. This type of pattern can be used to recognize the possible continuation of a trend as well. And it's important to factor in the volume of the asset at the time of the pattern. The initial price increase and decrease should occur during the period of high volume, while the consolidation period should accompany a time of lower and decreasing volume. Bear flags may not always show declining volume levels as well during its consolidation phase, as volume levels are generally higher during the downtrends. Here's what they look like. So here's an example of a bull flag. Prices were at this lower level. We're seeing some sort of uptrend. Prices are coming up. We reach a high and we enter in some sort of descending rectangular pattern, which looks like a flag. This is our flag pole and this is our flag. The idea is that we're looking to see how price breaks out of this contrary motion, right? We were coming from this ascending market structure. We've entered in this phase where prices are starting to come down, right? We're starting to see lower highs, lower lows, and then a potential breakout towards the end of the bull flag. In this particular case, bull flags occur during an overall uptrend, increasing prices. It can follow a dramatic move upwards, so maybe some sort of spike upwards, and then there's some sort of period of consolidation. Prices are starting to stabilize, and it's usually followed by further price increases after the flag. Contrary to the bull flag is the bear flag. Bear flag occurs during a downtrend where prices are falling, and in this situation it follows a drastic price decrease and then is followed by a continuation of further price decreases. In this situation, we are in the middle of a descending market structure. Prices are coming down. Perhaps there is some sort of drastic price spike downwards. Price begins to recover, and we can form a rectangular shape, slightly slanted, based on the ascending highs and ascending lows within the pattern of the flag. And then at some point we would see a continuation of further price increases at the end of the flag. So there's a few ways to trade these flag patterns. It's important to identify three main points when trading off of flag patterns. First, we want to look for our trade entry. In this case, we want to wait for the initial breakout when entering the trade. Otherwise, you risk falling for false signals. We also want to consider the stop loss. Setting up an accurate stop loss can be crucial to protect one's capital. Traders usually use the opposite side of the flag pattern as a stop loss price point. An example of this could be found where if the upper trend of a bull flag pattern is $60 and the lower section of the pattern is $55 per coin, a price below $55 per coin would be a good price point for a long trade stop loss order, because if we see some sort of lower low beyond 55, it's no longer a bullish market structure. We're starting to see a breakdown. So that's once again, it goes with the idea of setting stop losses where your trade idea is invalidated. We also want to consider our profit target. Arguably, it is more important to know when to exit a position than it is when you enter the trade. Arguably, it's harder to exit a position than it is to enter. Cautious or more reserved traders may want to use the difference between the flag pattern trend lines to set a profit target. Now, if the difference is $5, let's say 60 minus $55, then the trader may want to pull profits when the price is $5 above the breakout point. Now, a bullish trader, someone who's really wants to take on more risk, they may base their predictions on the measurement between the pattern's high price and the base of the flagpole to set a sell target. If the low of the flagpole is $45 and the top of the flagpole is $60, they may aim for a $15 price increase above the breakout point. Here's our example. So what we're looking for, once again, prices are coming down after the large dramatic spike upwards. We're looking for a breakout, and we're looking for a retest of this breakout line formed by the highs in the bullish flag pattern. Here, this is a good potential entry for a long position. And there's two ways, once again, what we can consider for profit targets. first of all, in regards for a stop loss, we would want to set a stop loss below the lowest point of the bull flag. In this case, it's here. So we would set our stop loss here because a further low or a lower low than here would invalidate the trade idea that it's a bullish continuation pattern. What we want to consider for a more conservative approach, what we could do is to look for a difference between the high point and the low point of the bull flag and consider, all right, so let's say this is $60, this is $55. We could subtract 55 from 60 and consider $5. All right, well, from this point, we can consider a $5 increase at the bare minimum. That might be the place to start taking some profits, or maybe just completely close out the position, depending on the trader. Now, a more aggressive trader, someone who's looking to take on more risk, they may consider the high price of the pattern, so let's say here, and then the base of the flagpole, which we can consider here, right? So the difference between these two areas, we could consider the subtraction of that, and then consider an even larger price increase. We could even say this is the base of the flagpole. Let's say this is $60, this is $45. We can subtract that. Maybe we can consider the flagpole extended from here, and now we're looking for a $15 increase from our trade entry. The next chart we'll take a look at is the bearish flag. So it's similar to the bullish flag, but this time we're looking for a continuation to the downside. In this situation, prices were coming down. We see a large, particularly dramatic spike downwards. Prices attempt to consolidate, and maybe there's a little bit of a retracement back upwards in this flag-like or a rectangular-like figure. And eventually there would be some sort of breakdown, I should say, beyond the flag positioning, and a retracement back up to retest it. It is ultimately rejected. That's what we're hoping for, because up until this point, we don't know what exactly is going to happen. So in this situation, we would wait for price to retrace back up to the flag. We would attempt to enter a short position to capitalize on the trend that we're expecting to continue, right? We're coming from this bear trend, this downward market momentum, downward market structure, and this is a continuation pattern, or what could be a continuation of it. So we're looking to enter a short trade here. Once again, we could set our stop loss just above the highest point of the flag, which we can consider here. And we can consider two different ways for profit targets. Once again, we may want to consider the difference between the high point and the low point of the flag. So let's say our highest point is $60 and maybe this is $45. Maybe we want to consider maybe a $15 spread. So let's say this is $15 or maybe even $10. We can start taking profits around here. We can also, once again, consider the base of the flagpole. So the base of the initial candle that started, or the initial move that caused that dramatic shift and a dramatic spike into the beginning of the flag position, and also the lowest point of the highest point, I should say, or lowest point of the flag. So let's say maybe there's some sort of point at $70 and price comes down to $45. Maybe we can consider a continuation of even more, maybe even $25, depending on how aggressive and how much risk you want to take on. I personally wouldn't wait that long. I would be much more conservative with my profit targets, especially when shorting. The next pattern we'll take a look at is the pennant. So a pennant is a type of flag where the area of consolidation converges, as shown to the left. We're seeing converging prices, lowering highs and higher lows over a period of time. pennants can be considered to be neutral patterns as well, and their interpretation depends on the situation at hand. Now, pennants differ from other patterns with converging lines such as wedges in that pennants are considered a pause in the trend. We're seeing a pause in the market direction, in where price is moving towards, price is starting to move sideways and not in a clear direction. In wedge patterns, prices are still trending up or down. The only difference between a bullish and a bearish pennant is what direction price will go to towards the end of the pennant. Now, in regards to trading pennants, consider the volume during a pennant scenario. The period of consolidation should have a lower or decreased amount of volume compared to the flagpole, and a breakout should happen during higher volume. Traders may look to enter a position after a breakout from a pennant pattern. Now, one may identify an overall bullish trend and could place a limit buy order above the pennant's upper trend line so that when the asset price raises, they are in a position to capitalize on their entry position. Price targets for pennants can be determined by taking the initial flagpole height and adding it to the breakout price. In this instance, let's say if a coin price raises from $20 to $25, drops to a consolidation range from about $22 to $24, and then breaks out at $23, a trader may consider a price target at $28, which we would consider the difference between, or the addition, I should say, from the breakout point to the difference between the initial flagpole height. So 25 minus 20, $5. We're adding that to the breakout level. We're looking for a $5 increase. In this situation, for pennants, a stop loss could be set at the lowest point of the pennant consolidation pattern as a safety net to prevent losses in case of a overall trend reversal. This is for a long position. If you're looking to short a pennant, you would look to set the stop loss at the highest point of the pennant consolidation pattern. Here's the example of our bullish pennant. Once again, we're seeing some sort of spike upwards, and prices are entering a period of consolidation, and we're seeing a tightening range, lower highs, higher lows over a period of time. We're looking for a breakout, a retest of that breakout line, or a retest of the top part of the pennant, and then a continuation in the bullish direction. For a bearish pennant, it's a similar concept. We're looking for a downward market movement, a spike down. Prices are entering some sort of consolidating range where the range is getting tighter over time. We're seeing lower highs and higher lows over time, period of converging. We're looking for price to break down beyond the lower part of the pennant and a retracement back to it. This is where we would enter our short position, and price at this point should be rejected and continue to the downside. Moving on to triangles. Triangles are candle patterns that show a converging price range that typically precede a continuation of the overall trend. The price action range within the triangle shows a pause in the overall trend, but may indicate a reversal or a continuation. First type of triangle we'll look at is the symmetrical triangle. Symmetrical triangles indicate a decreasing upper trend line, lower highs, and an increasing lower trend line, higher lows. Here we see this is point of converging, where both occur at an equal angle. This pattern is considered a neutral pattern and displays a period of consolidation. It's important to factor in other aspects of the market environment to determine the outcome of neutral patterns. Sometimes they can be considered neutral. It really depends on what direction price was coming from beforehand. Now, they can be considered similar to pennants. The main difference between symmetrical patterns, symmetrical triangles, and pennants is that symmetrical triangles are much larger and pennants are much smaller in size. So maybe we see some sort of symmetrical triangle where we're seeing a rather large volatility in these price swings that are slowly decreasing and entering some sort of converging focal point. Now, once again, we want to see a confirmation of a breakout either to the upside or to the downside, depending on the situation, and a confirmation of the trend if the price comes back to retest the breakout line. And this is where we would place our entries. In this situation, here's our bullish symmetrical triangle. Price has entered into this consolidating phase, similar to the pennant pattern. We're looking for a breakout to the upside, a retest of the top part of the symmetrical triangle. We're looking to place a long entry at this point because it's expected that this will hold, and we were looking for a continuation and a reversal to the upside, which would continue the overall market structure, right? We're coming from this bullish area. We're seeing these higher highs, higher lows. We've entered this pattern, and we're looking to continue the overall pattern. Likewise, in a bearish symmetrical triangle, we have come from a bearish market structure, right? We're seeing declining prices. We've entered into this consolidating figure. Prices are converging onto a single focal point. At some point, we are expecting price to break down beyond the symmetrical triangle. And at some point, we are looking to see if it retraces and retests this breakout level, this line. If it does retrace, this would be a good position for a short position because overall it is expected and price is inclined to continue to the downside. Once again, we do want to set stop losses in both situations. Similar to the pennant, we want to have our stop losses set at points of invalidation. In the bearish situation, we would set our stop loss just above the highest price point of the symmetrical triangle, and in a bullish symmetrical triangle we're looking to set our stop loss beyond the lowest point of the symmetrical triangle. The next triangle we'll discuss is the ascending triangle. Ascending triangles are formed when a horizontal line of resistance appears and a rising trend line is shown, indicating a series of higher lows. As the lows of the pattern continue to raise, pressure builds at the resistance area, where if the price does break through, a breakout could ensue, along with a period of increased trade volume. Now, the main difference between an ascending triangle and a symmetrical triangle is that in an ascending triangle, the highs fall in the same price level, forming a horizontal line. The consecutive highs form higher lows form an upsloping line, indicating buying pressure is mounting. We're starting to see a convergence where prices are starting, the floor is starting to get higher, and prices are being pushed to that level of resistance, and the expectation is that it cannot hold if the floor continues to raise. In this situation, confirmation is reached when price breaches the upper line and retraces back to it. If the level of support is held, then the trend is considered valid. A stop loss can be placed below the lowest point of the triangle. For if price falls below that level, then the uptrend is considered invalid, right? We're looking to see consecutive higher lows over time. Here's our example of the bullish ascending triangle. Prices have continuously reached this peak, this resistance level, and continues to test it, while all the same time producing higher lows over the period of time. Prices continuing to build and pressures continuing to build over time, and at some point price will reach past this resistance level, and what we're looking for is for a retracement to retest this this breakout level This is the ideal placement for a long position. And at this point, we're looking to see price hold above this support level, this breakout level now acting as support, and continue to the upside. To counter the ascending triangle, we are looking for the descending triangle. In this situation, there is a horizontal line of support formed along the bottom of a price pattern, along with a decreasing trend line indicating lower highs. We're starting to see these lower highs, and they're continuously testing this level of support. As price action of the asset bounces off that horizontal support line and continues to produce lower high points, selling pressure continues where the price can break through the horizontal support line. We're looking to see a breakdown, right? Once again, we're in a descending triangle. We're overall in a descending market structure. This is a pause or a continual, maybe a period of consolidation. Prices are consolidating and they're continuously pushing against this level of support. We're looking to see that continuation, that breakdown beyond this support level where prices can continue to go down. And this breakdown is typically followed by a spike downwards with a period of high volume. It is important to note that downtrends, especially spikes with downward movement, they're usually correlated with high periods of volume. There's typically even more volume on the way down than there is the way up. This could be as a result of people trying to buy the dip, or people just selling into the hands of people trying to buy the dip. There's a lot of reasons why that is, and that's something that I would look for in our lesson on volume. For a bearish descending triangle, the ideal trade entry here would be to wait for price to break down past the horizontal line formed and to retrace back to it. If this level of resistance is held, then the pattern is considered valid and the downtrend continues. Short position in this situation can be opened here once the resistance level is held. A stop loss can be placed above the highest high in the triangle, as if price were to exceed that level, then the downtrend is considered invalid. Here's our bearish descending triangle. Prices are falling. We're seeing a declining market structure. We've fallen into this level of consolidation. Overall, the bottom line of support is holding, but we are seeing declining highs, lower highs over time. This is a bearish sign, and a sign that overall sellers are pushing. Selling activity is taking over the market. We're looking to see for the breakdown beyond this level of support, a formation of a lower low, and some sort of retracement back to this level of support. This would be an ideal short entry because the expectation is that this is going to continue to hold and prices will be rejected at this level of resistance now and continue to the downside. The next pattern we'll take a look at is the cup and handle pattern. This is considered a bullish continuation pattern, and this is one of the more famous patterns and well-liked patterns where we see in trading, where we see some sort of market structure where prices reach this high, prices come down and follow along in this cup-like or arc, right? We see prices come down here. They would not be this high. Prices would stay down here and then form another high at that same level or near it, and then form a slightly smaller arc where prices comes back down and then comes back up to breach beyond the breakout level formed between the three highs. So this type of pattern is considered a bullish continuation pattern, indicating price could continue to move upwards from the handle part of the pattern. It's formed by two convex arcs, a large arc and a small arc, where each end of the point of the arc hits a similar level of resistance. These arcs form the shape of a cup and handle. The small arc, the handle, is rejected from the resistance level but forms higher lows, indicating that buying pressure is increasing. And the ideal trade entry would be to wait for price to break out past the resistance level and retrace back to it. If the level of support is held and the price continues upwards, then the pattern is considered valid. An ideal stop could be placed at the lowest point in the handle, as if price were to fall below this, then the uptrend could be considered jeopardized. Here's an example of this playing out. Once again, prices are coming from this lower region. We're in a bullish market structure. Prices reach this level and is rejected, and it's following along this arc. Once again, this should not be this high. Prices would be coming up to here. If once again is rejected from this level again, from this high, it forms a similar high to the high formed below it, or formed before it, and it is rejected again. This time we're forming overall higher lows, indicating buying pressure is taking over and is still continuing, right? We're at this mounting level of resistance, but there's a mounting increase in buying pressure, notably by the higher lows formed here compared to here. Prices would follow along this arc in an arc-like format, and eventually we would see some sort of breakout. What we want to do is we want to open up a short trade and wait for the retracement of the breakout back to the breakout line. We would open up a long trade, I should say, and this would be a good opportunity because the expectation is that prices will continue to move to the upside given the market structure. The reverse of the cup and handle is the reverse cup and handle. This is the situation where we are in a bearish market structure. Prices are declining and we have fallen into this maybe level of support. Prices are rejected from the level of support and are continuing to move up for the time being. We would follow along this in an arc-like structure. We would fall back to the support level. Once again be rejected, this time forming lower highs, and then back to the level of support, which we would then look for a potential breakdown of the level of support and a breakdown of the market structure. So this is considered a bearish continuation pattern where the lows form convex arcs, one large and one small. The smaller arc is formed by lows falling in the same price level as the large arc lows, but the lower highs as well, indicating that buying pressure is weakening and selling pressure is growing. For this instance, we want to look for a short entry. We want to see price break down past the horizontal line formed by the three lows of the pattern, then wait for its retracement back to that line. If the former support level, which now acts as resistance, holds, the pattern is considered valid and the short trade would be considered successful. Here's a visualization of this in a second, and a stop could be placed above the high on the handle, as if price surpasses that level, then the downtrend could be considered invalidated. Once again, we're looking for this breakdown beyond this level of support. Price comes down, retraces back up to it. This is an ideal situation to open up a short trade. The expectation is that we are in a overall bearish market structure. We're seeing declining prices. Price came down to this level of support. It came back up. There was maybe some sort of rally. We see a high formed here, but overall came back down to the level of support. Maybe price now forms a smaller arc, lower highs compared to the highs formed in this arc, and generally still pushing this level of support. We're looking for a breakdown beyond the level of support and some sort of retracement. This is where we enter our short trade. And as spoken before, we were looking to enter a stop loss just above the highs of the smaller arc, because if we do see a higher high than the high observed here, that would be an indication that there could be a potential change or shift in the market structure and would invalidate the idea of a bearish continuation pattern.